Very good morning to each and everyone, my dear children. So, welcome to the discussion of RTP for November 2022 examination with respect to the subject of advanced accounting. So, I'm here to discuss the fragile points in each and every question, and of course, coming to standards, we will discuss elaborately. I mean, we'll explain the whole question and we'll go with the solution also. But coming to all the remaining questions, we'll just go through the question. We will check out the fragile points and we will check out the treatments. So that you will be getting an overall idea with respect to that question. And if the question is totally different, we are going to concentrate a bit more. But if the question is pretty easy and where we have done in our classes, then of course no need to extend more discussion on that kind of questions. Anyways, let us start. Of course, before starting the discussion of RTP, first of all, there will be some amendments. And coming to here, Schedule 3 amendments, of course, relating to Part 1, there was an PDF which was attached, of course, and the thing here that I would like to tell you is all about, you will be concentrating this in Group 1. It's like accounting. So, I'm not concentrating greatly on this intent. And moving on to the next thing. Guidance notes on ESOPs. I would like to clarify one thing. So, this PDF is the chapter relating to ESOPs which was released for the recent attempt. This PDF document is relating to Schedule 3 annexures which were given in ICAI recent study material. And let's concentrate on this one. Of course, it's nothing but the new study material relating to the chapter of ESOPs is the PDF link here which was given. Look here. The students are advised to refer link for the revised chapter. Anyways, I don't want to tell you the commonate parts, what is there previously and what are there now. But I would like to tell the major differences what have been occurred. And the first part is all about, of course, as like there are two values or two values for computation of ECE, employee compensation expense, and the two values or two methods is all about intrinsic value method and fair value method. Intrinsic value is nothing but market value as on the date of grant minus exercise price. Fair value is something which is literally nothing but market value. Of course, the computation of fair value of a share where you are going to learn in CA final. But as of now, in all the questions that were being relating to ESOPs, all the questions related to fair value, and the fair value will be given directly in the question itself. But this is what the old method is all about. I mean to tell the old materials were all about to find employee compensation expenses. There are two methods, intrinsic value method and fair value method. Coming to intrinsic value method, it's market value as on the date of grant minus exercise price. And coming to fair value method, it is nothing but directly given in the question. It will be directly given in the question. And of course, the computation of fair value you will be learning in CA final. That's not necessary now. Now moving on to the new thing, main change is all about employee compensation expense, as like he told in the theoretical part, intrinsic value method and fair value method, all those things are quite common. But coming to the problematic part, he has changed a small thing, that is all about, he is not asking the question to solve under which method, whether is it intrinsic value method or fair value method. That sort of confusion was totally eliminated. And one more thing, my dear children, there are one or two questions in our material, something like where he has given fair value of the option is ₹9, and also he will be giving exercise price of the share, say for example 39, and what I mean to tell is all about market value is all about say 50. Then you are having two confusions. I mean to tell, in the question he has given three things: fair value of the option, exercise price, say 50 is nothing but market price as on the date of grant. So if you observe this one, fair value is ₹9, but if you observe the intrinsic value, it's like 50 minus 39, which comes to 11 rupees. So biggest confusion to the students to follow which method. Is it intrinsic value or fair value method? But now such sort of conception is not there, because he has been, he has done the uniformity in all the questions, something like fair value of option, which will be directly given in the question, exactly equal to intrinsic value of the option if you being students have computed that. I mean to tell, say for example, if fair value of the option is given as rupees 9 in the question itself, not having any contrary, he is giving one more statement, and the statement is all about, say for example, market price as on the date of grant is equal to rupees 50 and exercise price is equals to rupees 41. So if you've got the difference or done the difference for something like 50 minus 41, you're going to get rupees 9, where exactly fair value is equal to intrinsic value. So this contrary, previously we used to have these kind of contrary in the questions, but now we have come across with these kind of questions in each and every question. In each and every question we are getting these 2 points where fair value of an option is exactly equal to intrinsic value of the option. This will be given in the question. If you compute, you are going to get this one. So from now there is no myth, from now there is no confusion to the students which method to follow if the 2 things were given in the question. So this is what the major change in problematic part he had brought. And of course there are some minor changes even in the theoretical concepts also, but I don't think those are that much important for examination point of view. But provided, my dear children, please go to the definitions of ESOPs where some things were changed. Terminology used in the ESOPs. Previously we used to have vesting, like a different kind of decision, right to apply or something like that. But now vesting is modified a bit. So my intent is all about with respect to the revised edition of ESOPs. Point number 1, relating to the examination. We are here only to discuss the things that were purely relating to examination point of view. Anyways, the things that you have to discuss is all about number 1, terms of ESOPs must be revised by you, my dear children. And the second one, as I told you, whatever the confusion we are having between fair value and intrinsic value, now in all the questions such sort of conception is totally eliminated. Now coming to LLP Amendment Act. Coming to LLP Act, we are having 2008 and there is an Amendment Act in 2021. I mean to tell all about amendments. So coming to amendments, first one, small liability partnership. He has been modified with respect to small liability partnership, and also definition of business has been modified. Previously there used to be something like if any occupation which is notified by the government that it is not a business, then automatically it will not be included in the activities of the business. But now that is being totally eliminated. Whatever which is relating to trade, profession, service, occupation, industrial activity, economic activity, everything will be coming under business definition. But previously there used to be an exclusion statement, something like if central government notifies that a particular occupation is not a business, then that is not an business. That is not a business previously, but now such sort of thing is not there. And take care, my dear children, the definition of designated partner is also substituted from 82 days to 20 days. Financial disclosures and returns, of course, these are not that important for examination point of view. Again, for examination point of view, he may be asking you one question relating to LLP for 5 marks. So take care, since there are amendments in LLP, he may ask you with regards to those things. And yes, so you just can go through the financial disclosures and returns so that you can understand, nothing to discuss. And moving on to the next thing, section 35, the following shall be inserted. Previously such sort of insertions were not there. And coming to banking, HTM category with respect to SLR, statutory liquidity ratio with respect to held till maturity securities, NDTL, net demand and time liabilities, percentage is being changed. So you can just go through that percentage. So as of now, what is the percentage applicable for, as it 31st March 2024 is 19.5%, as at 31st March December 2023 is 20%, and September 30 2023 is 21%. So as of now, since we are here, we may be applicable with 21%. Take care. So as I told you, September 21 edition is totally applicable. Oh, I'm sorry. Yeah, not this one. June 30 2023, recent percentage is like 22% for the applicability of SLR ratio. And one more thing that must be concentrated here is all about September 2021 edition is applicable for November 2022 examination. So whatever the ratios, whatever the percentage is given in the edition of September 2021, just you can happily follow that one for all the remaining chapters. And of course, as like the tradition is being continued, in AS or not applicable at all, only accounting standards are applicable. So let's start with the questions. So chapter number 1, dissolution of partnership. Question number 1A. This question is an old question itself, nothing great, and moreover here they have asked from basic dissolution of partnership. From basic dissolution of partnership they have covered piecemeal distributions. Again under piecemeal distribution they have covered higher relative capital method but not maximum loss method. So let's go with the question. There's nothing great with question, but there are some fragile areas where we need to concentrate. Partners PQR have called you to assist him in winding up the affairs of their partnership on 31/12/2020. Their balance sheet as at that date is given below. Capital accounts PQR creditors, and coming to assets, land and building, plant and machinery, furniture and fixtures, stock, debtors, cash at bank, loan P, loan Q total. The partners profit sharing ratio is 4:3:2. Cash is distributed at the end of each month since it is piecemeal. A summary of the liquidation transactions are given below. Jan 2021, 9,000 from debtors, 8,000 from sale of furniture, 1,000 liquidation expenses paid, 6,000 is cash retained in the business. So he is giving all the data for all the months. For March also 38,000 plant and machinery, 10,000 from stock, 1,700 from liquidation for liquidation expenses, 41,000 for land and buildings, and finally no cash is retained in the business. But you need to take care about this statement actually. As a part of his payment of his capital, are accepted a machinery for rupees 9,000 where the book value is rupees 3,500. We are having the same question in our study material. It is just change of numbers. And what I need to concentrate here is all about number 1. First of all, don't forget to consider existing cash. There are many of the students who will be doing directly from 9,000 plus 10,000 minus liquidation expenses 1,000, since cash is retained minus 6,000. This is what the style where a majority of the students are being adopting. But you people are forgetting the opening balance of cash to consider. So please don't consider the opening balance of cash which was given there is all about 9,000. So 9,000 plus 9,000 plus 8,000 minus 1,000 minus 6,000. That is your cash available for the month of January. But take care, my dear children, again, whatever the cash available for the month of January is alone, the total cash alone cannot be enjoyed by the partners. Reason being there are some outsiders who are nothing but creditors. So first of all, out of the available cash for the month of January, pay to creditors, and if anything is remaining, just the partners must be paid. And while going with the partners, take care, there are loans which are at asset side and there are capital accounts which are at liability side. Since these two things, parts for set off, capital firm has to give to the partner and loan partner has to give to the firm being an asset. So we can set off. So P 65,000 and loan P 13,000, 65 minus 13, Q 50,500 and minus loan Q 7,000. The net figures will be the distribution to the partners. And coming to February, don't forget to consider the opening balance 6,000, liquidation expenses minus 1,000, 2,000 cash is retained in the business. So available cash is only some part. So available cash must be distributed to the partners. But before that, take care, my dear children, if you observe this one, are accepted a machinery for rupees 9,000 for book value of rupees 3,500. Yes, before starting the problem, first of all, you have to find who is having relatively higher capital. So to find relatively higher capital, you have to draft statement of higher relative capitals or statement of surplus capital or statement of excess capital by considering relative capital, excess capital, effective capital, what not the things are. And now you have to allot the ranks. Likewise, whoever are having surplus will be allotted with rank 1. After that, excess capital will become rank 2. And finally, you have to pay the original capitals which will become rank 3. Now, the major element that you need to concentrate and understand here is one more thing that, so say for example, particular rank is completed for repayment and now you have to pay to the two parties like R along with some other partner, say P for example. But since R had taken machinery at a value of rupees 9,000 which is more than that rank, the other partner must be compensated. For that purpose, you can take proportionate basis, or else if you want, you can draft one more statement of surplus capital or excess capital, where in all the ICAI materials, study materials, the same will be followed. So if you have encountered with these kind of statements, take care, my dear children, you need to draft one more statement of excess capital. Initially, you have to draft statement of surplus, statement of capital showing surplus, part 1, working note number 1, and also in these kind of problems, you will get working note number 2. That is all about one more statement you have to draft from the remaining balance of the previous distributions. Take the remaining balances of the previous distributions, again go for the rankings by considering this 9,000 there, and then you are going to get perfectly. So this is what question number 1A is all about. So in this question, things that ought to be taken care. Number 1, don't forget opening balance of cash to consider. Number 2, loan amounts must be deducted from partners' capital accounts in order to find the balance that is to be given to the capitals. And part 3, very, very important, is all about there is a part of asset which is taken by one of the partners more than his ranked amount. For that, you need to draft another statement, that is statement number 2 for computation of excess capital. So take care. Yeah, of course, LLP, can a partner called upon to pay the liability of MLP? If yes, under what circumstances? Of course, a partner can be called upon to pay the liability of LLP. So what are those circumstances is the question. So as like you can just go with the solution. It's been a tradition that one of the LLP questions is being asked in the questions for 4 or 5 marks at least. So if you're pretty sure to attempt that 4 or 5 marks, then you have to read it. Otherwise, my recommendation to all the normal students, you can take that question as a choice question. Even though you have lost 4 marks, you're going to get that 16 marks from that single bit of partnership. Next, advanced concepts of partnership. Here in advanced, he has chosen conversion of partnership from, conversion of partnership firm into a company. So let's go with the question. A and V, sharing profits and losses equally, decide to convert their business into a limited company on 31st December 2021, while their balance sheet stood as follows. Equity and liabilities, creditors, loans, bank overdraft, reserve fund, capital accounts A and V, debtors, bills, receivables, stock in trade, patents, plant and machinery, land and buildings. And the adjustments. The goodwill of the firm was valued at 2 years purchase of average profits for the past 3 years. Loan creditor to accept 7.5% redeemable preferences in settlement of his claim. Land and buildings and plant and machinery were to be revalued at 4,96,000. Vendors were to be allotted with equity shares. Past 3 years profits were given. You are required to show realization account, partners capital account in the books of the firm, assuming that all the transactions are duly completed. So nothing great, very easy. But one thing that you need to understand here is that vendors were to be allotted with equity shares. How much is not given. So take care. Here you have to compute net assets method. Assets minus outside liabilities, which is to be considered at agreed values. That is by considering 4,96,000. So take care. This is actually a bit important. And also pretty sure, my dear children, with goodwill, because goodwill is not limited just to super profits, just to simple average method and weighted average method. You have to pretty sure with super profits method and even also capitalization method, because something like you cannot take risk. My dear children, I'm just telling you, say for example, if there is a student who left partnership as choice, okay, and who doesn't know the computation of goodwill under super profits or capitalization method of goodwill, and in one of the questions, partnership, which is very difficult, so he has taken it as choice, and in amalgamation, if he has given with capitalization method, you will be booked there, because you don't know how to compute goodwill there, and you don't know how to compute partnership answer here, and automatically you are going to take a choice for that one. So it's something like just an ignorance of one method will be costing for 2 problems. So I don't think this is a wise choice. So take care. So nothing great in this question, is pretty simple. Transfer all the assets and outside liabilities to realization account at its book values, and reserve fund must be distributed to the partners, and of course capital accounts will be there in capital accounts itself, and compute purchase consideration by considering net assets method, and by considering agreed value, so that you're going to get a PC. And since it was not given anything that vendors to be allotted with equity shares, but how much to be given to A and how much to be given to V is also not given, and hence automatically it will become balancing figure. I mean, like, you're going to get total PC, but how much is to be given to A and how much is to be given to V will become a balancing figure. Take care. And accounting for ESOPs. Look at this question. You're going to get what sort of modifications that he has brought in the recent materials. Mehta Limited grants 1500 stock options to its employees on 1/4/2019 at ₹50. The vesting period is 2.5 years. The maximum exercise period is 1 year. Market price as on that date is 80 and fair value of the option is 30. All the options were exercised on 31/7/2022. Give the necessary journal entries if the face value is ₹10 per share. There are no options which were vested and lapsed, unvested and lapsed. There's no concept of lapse at all. All the options were exercised. All the options were satisfied with their vesting conditions. But if you observe one thing here, if you observe, fair value is given and also intrinsic value computation required data is also given. That is market price as on the date of grant minus exercise price, which comes to an amount of ₹80 minus 50, which is nothing but ₹30. And also if you observe, fair value is also ₹30. So what my point here is very simple, that your fair value is also 30 and your market price and difference between market price as on the date of grant and exercise price is also 30. So there's no confusion to the students now. This sort of statements were being brought in the questions which are relating to ESOPs. Anyways, question is pretty easy, nothing difficult, nothing great to discuss also. And coming to the next one, buyback of securities. Again, it's a kind of pretty easy question. Let's go with the same. Umesh Limited resolves to buy back 4 lakh of its fully paid equity shares of ₹10 each at ₹22 per share. This buyback is in compliance within the provisions of Companies Act and it does not exceed 25% of companies' paid up capital in a particular financial year. So he has very cleverly given one statement and made the question very easy to the student, something like buyback is in compliance with the provisions. So if at all he is asking you to compute whether the limits, whether the number of shares which are to be bought back by the company are within the limits or not as per Companies Act 2013 provisions, then you have to go with 3 tests. Outstanding shares test, resource test, last but not least debt is to equity test. But here such sort of thing is not required at all. Anyways, for this purpose it issues 1 lakh 11% preference shares of ₹10 each at par and the entire amount is received on being payable with applications itself. Sir, as I hope that you have remembered that for ROPS chapter, redemption of preference shares, and the chapter like buyback, if you are supposed to redeem a capital or if you are supposed to repay a capital, if you are supposed to repay or redeem a capital, first of all you have to match the capital requirement. How to match the capital requirement? It can be through 2 ways. Number 1 is through fresh issue. Number 2 is through creating CRR. Coming to fresh issue, for the chapter of redemption of preference shares, either issue of preference shares or equity shares is permitted. But for coming to the buyback chapter, fresh issue will include only preference shares, other kind of shares. And CRR, you can create the same from free reserves. If you observe here, the company uses 16 lakhs of its balance of securities premium apart from its adequate balance in general reserve to fulfill the legal obligations with regards to buyback. For your kind information, my dear children, for all the sections that are related to buyback in Companies Act 2013, securities premium is to be considered at par with free reserves. To tell how the free reserve is being considered, in the same way securities premium is also to be considered. And hence, for creating CRR, you can utilize securities premium also as per buyback. And fresh issue includes only preference shares for the purpose of buyback. If it is for the purpose of redemption of preference shares, fresh issue, both equity or preference, and CRR can be created only out of free reserves. So this is the difference, and take care. And next sub chapter, equity shares with differential voting rights, a common theoretical question. What is meant by equity shares with differential voting rights? Can preference shares be issued with differential rights? Of course, that's not possible. And differential rights are nothing but 2 things, DVRs and DDRs. differential voting rights and differential dividend rights. Of course, things are possible. So normally one share, one vote, and equity will not get a fixed dividend, but they may go with DVRs where different sort of voting rights, and DDRs where they may issue even equity shares with fixed dividend. For that purpose, it also needs to create DDR, dividend distributable reserve or dividend equalization fund. And next question, of course, a very popular question, many times tested, to find the voting rights in the purpose of winding up for equity shareholders and for preference shareholders. But in this connection, you need to understand one statement here, very, very important. If the paid up capital of the company is 80 lakhs and preference is 40 lakhs, don't be in a wrong notion that out of 80 lakhs, 40 is equity and 40 is preference. The notion of these questions are totally different right from immemorials, right from the publishing point of time. They have been considering that paid up capital for all these kind of questions in this chapter is considered as only equity. Again, if at all they have given in the question like total paid up capital, then both preference and equity will be considered. Take care, paid up capital to the extent of this chapter, it includes only equity. So 80 is equity and 40 is preference. So you can take the same in proportion. So total is all about 80 plus 40, 120. 80 is to 40. Again, 80 must be distributed in the ratio 30 is to 30 is to 20 is to 20. 40 must be distributed in the ratio 40 is to 30 is to 20 is to 10. And if at all given something like the total paid up capital of the company is rupees 80 lakhs, then this will become correct. Take care, paid up capital normally includes only equity. If the total term is given, then it will be automatically including both preference and equity. Coming to the next chapter, amalgamation of companies. The balance sheets of Truth Limited and Myth Limited as at 31/3/2021 is given below. Myth Limited is amalgamated with Truth Limited on 1/4/2021. The amalgamation is to be carried out in the nature of purchase. My dear children, in majority of the questions, amalgamation is being given in the nature of purchase, but not merger. Anyways, in this connection, I would like to tell you one more thing. In case of purchase, you are going to compare net assets and share capital. Net assets and PC. If the PC is more, it will become capital loss, transfer to goodwill. If the PC is less, yes, it's a capital profit and it will be transferred to capital reserve. And if it is amalgamation in the nature of merger and where you are following POI method, pooling of interest method, in such a case, you have to compare share capital and PC. If PC is more, of course it's a loss and it has to be adjusted against three parts: reserves and surplus of old company, that is transferor company; reserves and surplus of transferee company, that is new company; and say if all the reserves are utilized, then finally you can debit P&L account. Whereas if PC is less, then automatically it will become capital profit, which should be transferred to capital reserve. This is what you might have learnt. Of course, this is absolutely correct as per Expert Advisory Committee of ICAI. They have told that if there is less PC paid under POI method, it must be transferred to capital reserve, being a capital profit. But take care, ICAI had amended the same, because you might have learned the same in the classroom sections also. But take care, my dear children, now ICAI had in its books of materials, it had amended the same. And even if PC is less, it is not to be transferred to capital reserve, it must transferred only to P&L account. Take care, it must be transferred only to P&L account. I mean to tell, assets account debtor to liabilities to capital reserve is wrong, to P&L account is correct. So whatever, whether it is excess PC paid or short PC paid, that is not at all necessary for us. Whatever the excess or short that is paid must be transferred only to P&L account. I mean to tell, it must be adjusted only against the free reserves of the company. Take care. So let's come back. Amalgamation in the nature of purchase is this one. Equity and liabilities, shareholders funds, share capital, note 1 attached. So let's go with note 1 immediately. Only equity shares were given. Okay. Reserves and surplus, note 2. So reserves and surplus, general reserve, P&L account, export profit reserve. These two are free reserves and this is a statutory reserve. Statutory reserve in amalgamation in the nature of purchase has to be transferred along with a new account called AAR account. So amalgamation adjustment reserve account debtor to statutory reserve, that is here EPR, export profit reserve account. So that is a new thing that you need to remember. I mean, that is a new separate entry you have to write. Note 3, non-current liabilities, 14% debentures only in MIT Limited. Current liabilities, note 4. Two things, trade payables and other current liabilities. Okay. And coming to assets, non-current assets, property, plant and equipment. Okay. Investments done. Current assets, note 5. Inventory, trade receivables, cash and cash equivalents, done. So in the entire balance sheet, there is nothing new except export profit reserve. Of course, that is also not new. It's just very easy. But you should remember that it cannot be transferred with regular journal entry. For that purpose, you have to record a separate journal entry like amalgamation adjustment reserve account debtor to export profit reserve account. Now, observe. Truth Limited would issue 12% debentures to discharge the claim of debenture holders of MIT Limited. So take care. Truth Limited is issuing 12% debentures as a claim of debenture holders of MIT Limited so as to maintain their present annual interest income. So take care. Existing interest percentage is 14% for 1,50,000, but it would like to issue 12% debentures so as to maintain its original income. So it's all about 1,50,000 into 14% is equals to 12% debentures, that we don't know. I mean to tell 12% of new debentures account debtor, 12% of new debentures is equals to 14% of old debentures. We know this one. So that is equal to 14% of 1.5 lakh. Therefore, new debentures is nothing but 1.5 lakh into 14%. You are going to get interest. That interest divided by 12% will be giving you the number of debentures, new debentures in the company of Truth Limited. Non-trade investments which constitute 80% of their respective total investments yielded income of 20% to Truth Limited and 15% to MIT Limited. The income is to be deducted from profits while computing the average profit for the purpose of calculating the goodwill. Take care, my dear children, it is actually very, very important. Non-trade investments which constitute 80% of their respective total investments yielded 20% to Truth Limited and 15% to MIT Limited. So whatever the income from this non-trade investments are there, so check out investments 187,500 and 1 lakh, out of which non-trade investments constitute for 80% and yielding some respective percentage of income to Truth and MIT. So out of in total investments, non-trade are 80% and to Truth it is 20% and to MIT it is 15%. So compute interest on non-trade investments and don't consider the same for goodwill. You will be getting the same while going with the computation of goodwill actually. I guess if I was not wrong, you're going to learn the computation of goodwill in partnership and also of course in amalgamation. At that time, you will be knowing that don't consider abnormal items, consider only normal items, don't consider non-trading items, consider only trading items, rectify all the errors. You will be learning the same in partnership and also you might have learned the same in your foundation and now you need to apply the same here. So take care. I already told you, be attentive with respect to goodwill. Never allow your ignorance with respect to a small point to cost one whole problem. And if you observe here, profit before tax of last 3 years of the companies were given and goodwill is to be calculated on simple average by using capitalization method as 18% NRR. So take care, you have to go with capitalization method. I mean to tell, consider these profits minus Truth Limited 20% of its non-trade investment, which is 80% of total investments for all the 3 years. And the same thing here also, minus 15% of 18% of total investments, even for MIT Limited also. You're going to get the goodwill of Truth Limited and you're going to get the goodwill of MIT Limited. Anyways, so moving on to the next thing, goodwill is to be calculated as per capitalization method, after which you are going to get SAP. You are going to get the revised profits. From that revised profits, you compute SAP, simple average profits, divided by 18% NRR is nothing but capitalized version of goodwill, which is otherwise called as normal capital employed. And this normal capital employed has to be compared with actual capital employed. Your actual capital employed is nothing but assets minus outside liabilities. So you have to consider assets minus outside liabilities, of course, at agreed values, and compare with this actual capital employed and normal capital employed. You are going to get then with respect to goodwill. So take care, that's actually very important. And if you observe at last, PC is to be discharged by Truth Limited on the basis of intrinsic value per share. Now if you observe intrinsic value, if given in the question, you need to consider the same. If not given in the question, you need to compute that intrinsic value. So intrinsic value here is nothing but take Truth Limited, take MIT Limited. Take all the assets and all the liabilities at agreed values, including goodwill. After that, you are going to get some values. I mean to tell assets minus outside liabilities, including goodwill at agreed values. Then you are going to get net assets. Then compute number of equity shares. Net assets by number of equity shares is nothing but intrinsic value. Now consider number of equity shares multiplied by intrinsic value. That is what the MIT Limited. So MIT Limited total net assets divided by intrinsic value of Truth Limited will be giving you number of equity shares that are to be issued to MIT Limited. And since issue price is also not given in the question, consider the issue price as intrinsic value itself, of which again two parts will be there. One part will become face value and another part will become securities premium. Anyways, take care. This question of amalgamation is very different. What are the different points in this question? Point number 1, computation of goodwill is very, very different. While computing goodwill, one more thing that could be appreciated is all about there is no change in the agreed values at all. Whatever the book values are exactly equal to agreed values, of course, except debentures. So goodwill is to be computed as per capitalization method. For capitalization method, first of all, you have to find normal capital employed. For normal capital employed, you have to find simple average profits divided by 18% NRR. Simple average profits to be considered for 3 years average. But for consider 3 years average, you are having 3 years profits should be deducted with non-trade income on non-trade investments, which is nothing but respective 20 or 15% of non-trade investments, which is nothing but 80% of total investments. This is what goodwill. And after that, you have to compute PC. PC is nothing but net assets method, since directly given intrinsic value. Net assets method or nothing but intrinsic value. If given in the question, you need to consider the same. Since here it is not given in the question, you have to compute. So assets, Truth Limited, MIT Limited, assets minus outside liabilities at agreed values, including goodwill. After that, you are going to get net assets total value. If you consider number of equity shares and divided by number, you are going to get intrinsic value per share. So now number of equity shares of MIT Limited multiplied by intrinsic value per share of MIT Limited, which is nothing but net assets of MIT Limited divided by intrinsic value of Truth Limited. You are going to get number of equity shares, which is PC. And after that, since the issue price is also not given, 10 rupees will become face value, since it was very clearly given that 10 rupees is the face value, and remaining balancing figure will become securities premium. At the end, my dear children, the prettiest thing is that he is just asking you to prepare balance sheet. But to prepare balance sheet, first of all, you need to go with computation of PC. So computation of goodwill, computation of PC, and finally you can go with balance sheet. There is no difference in the balance sheet except PC and debentures. So that is up to question number 6, if I was not wrong. Yes, exactly, up to amalgamation. Let's continue with question number 7, internal reconstruction. So let's start. Planet Limited has decided to reconstruct the balance sheet since it has accumulated huge losses. The following is the balance sheet of the company as on 31st March 2022 before reconstruction. So there is a company, Planet Limited. It is decided to reconstruct its balance sheet since reason for reconstruction is all about it is having huge accumulated losses. And the following is the balance sheet of the company as at 31st March 2022. Before reconstruction, there is a balance sheet which was given. We need to reconstruct the balance sheet which is given here. Equity and liabilities, shareholders funds, share capital, note 1. I guess for all the liabilities there are notes. Note 1 share capital, Note 2 reserves and surplus, Note 3 long-term borrowings, Note 4 trade payables, Note 5 other liabilities. Let's go ahead with each and every liability. Share capital, authorized. In some of the questions he won't give authorized, whereas in some of the questions he will be giving authorized. 300 lakh equity shares of rupees 10 each and 12 lakh 8% preference shares of rupees 100 each. Okay, so that's authorized share capital. Issued, subscribed and paid up capital, 150 lakh equity shares of rupees 10 each, fully paid up. Okay, and 6 lakhs 8% preference share of rupees 100 each, fully paid up. So these are like issued, subscribed and paid up capital. Even the same data is given here. And next one, Note 2 reserves and surplus, debit balance of P&L account. So take care, since it is debit balance which is given at liability side, it is representing a negative balance. So it is representing negative balance. So that is like debit balance which is in reserves and surplus. Long term borrowings, 6% debentures secured by freehold property and director's loan. There are two long term borrowings. One is like debentures secured and another one is like director's loan. Note 4 trade payables for goods which is nothing but creditors. 5 note other liabilities, interest accrued and due on 6% debentures which is totally relating to debenture holders. So on a whole, total due that is to be paid to debenture holders is all about 600 plus 36. On a whole it comes to rupees 636. Next, so that is all about liabilities and total. Okay, and coming to assets. Assets are non-current assets. The first one is PPE. I guess again for all the assets there are notes. If you check out PPE note number 6, current investments note 7, inventories note 8, trade receivables note 9, cash and cash equivalents note 10. So let's continue with each and everything. So note number 6, 7, 8, 9, 10. PPE. So there are two PPE given, freehold property and plant and machinery. Current investments, only one current investment in equity instruments. Inventories, finished goods. Okay. Trade receivables for goods which is literally nothing but debtors. Cash and cash equivalents, balance with bank which is literally nothing but cash and cash equivalents we have provided just with bank, no cash at all. Anyways, that is the end of the whole balance sheet. So nothing great to discuss in balance sheet except only one thing, that debit balance in P&L account. Moreover, by looking at these lines, you must be in a position to understand that the question is all about internal reconstruction, and since it is having huge accumulated losses before reconstruction, after reconstruction the aim is to wipe off the same loss. So let me move on further to the adjustments. Fine. The board of directors of the company decided upon the following scheme of reconstruction with the consent of respective shareholders. Okay. So with respective shareholders, the board of directors of the company have decided to approve the following scheme. Of course, respective shareholders have consented for the scheme. Preference shares are to be written down to rupees 75 and equity shares to rupees 2 each. Very simple. Rupees 100 face value preference share is to be written down to 75. So remaining 25 shall be transferred to capital reduction account, and rupees 10 equity share is to be written down to rupees 2, and accordingly rupees 8 is to be transferred to capital reduction or reconstruction account. And moving on to the next thing, preference share dividend in arrears for 3 years to be waived off by 2/3, and for balance 1/3 equity shares of rupees 2 to be allotted. So point number 1 that could be appreciated here is that preference dividend in arrears is a contingent liability. If it is a contingent liability, then automatically you need to understand one very important point, that is all about contingent liability will not be having a record in the balance sheet. And hence if contingent liability is waived off, no need to write any specific journal entry at all. Whereas my dear children, remember and listen very carefully, if at all contingent liability is paid, since it is not having any record in the balance sheet, and if the contingent liability is paid, it has to be routed through reconstruction account. So reconstruction or capital reduction account debtor to if you have paid cash or bank, but now in this situation you are issuing equity shares, so to equity share capital account, and hence the literal journal entry will be like capital reduction account debtor to equity share capital account. So that is what with regards to point number 2. Take care, preference dividend in arrears is a contingent liability, and if contingent liability is waived off, there is no specific journal entry for the same, but if contingent liability is settled, you have to route through capital reduction or reconstruction account. And moving on to point number 3. Debenture holders agree to take one freehold property at its book value of rupees 450 lakhs in part payment of their holding. Balance debentures is to remain as a liability of the company. Check out first of all how much freehold property and how much debentures is there. 6% debentures 600, 6% debentures 600, and secured by freehold property, and freehold property is 825. 825 is freehold property. And what is the next stanza given? So debenture holders agreed to take freehold property, balance debentures to be remain as a liability. So in settlement of this 600, they have taken rupees 450 lakhs of freehold property at the same price, that is 450 lakhs. And hence automatically, my dear children, 600 minus 450, balance of debentures is 150 lakhs, and balance of freehold property 825 minus 450, rupees 375. This is what the balance. So now for the due of rupees 600, debenture holders agreed to take freehold property which is 450 lakhs, and the agreed value is also 450 lakhs. And hence it's very simple, something like 6% debentures account debtor to freehold property account 450 lakhs. Take care, my dear children, you need to appreciate another thing in this context, that if given something like 450 value of freehold property is taken over something at 500 lakhs, then of course the balance will be 100 lakhs and this will not change. But here one thing that should be considered is that first of all 450 book value of freehold property shall has to become 500 lakhs. In the sense you have to do upward revaluation to the extent of 50 lakhs. That is, first of all, before settlement to debenture holders, you have to revalue the assets and liabilities. That's all about freehold property account debtor to capital reduction account 50 lakhs. Once if that is done, I mean to tell all about upward revaluation, 450 plus 50, total comes to 500. Now you have to give the same to 6% debentures to freehold property, which comes to 500 lakhs. But in this question there is no such problem because 450 lakhs was directly given as 450 lakhs. So no need to do anything specific only. So it's pretty easy. And interest accrued and due on debentures is to be paid in cash. That is also very easy. Check out how much is the interest accrued that you are having here. Somewhere, yes, 36 rupees, that is paid in cash. So it's a liability settled, nothing great. Remaining freehold property is to be revalued at 550. So 375 minus 550, which comes to 175 lakhs upward revaluation. So freehold property to capital reduction, whatever at the time of reconstruction should be routed only through capital reduction or reconstruction account. So take care. Next, all investments were to be sold out for 425 lakh rupees. So check out the investment accounts. Investment in equity shares 300 were to be sold at 425, leaving rupees 125 lakhs as profits. Very simple. Profits must be transferred to again capital reduction or reconstruction account. Point number 7. 70% of the director's loan was to be waived. Take care, director's loan is a liability but not a contingent liability. In point number 2, preference arrears dividend is waived. to the extent of 2/3, for which there is no journal entry, reason being it's a contingent liability, but here director's loan is a liability, and hence even for waiving off it is a kind of profit which must be transferred to capital reduction account. And equity shares of ₹2 each allotted for the remaining balance, that is to the extent of 30% of the director's loan. And next, point number 8, 40% of the trade receivables and 80% of the inventories to be written off. That's like bacha. So written off portions will be transferred to capital reduction account to the extent of 40% and 80%. Company's contractual commitments amounted to ₹900 lakhs and have been settled by paying a penalties of ₹72 lakhs. Take care, company is having some contractual commitments like a contingent liability or contractual commitment. Of course, I'm not telling that it is contingent liability, but similar to contingent liability. I mean to tell which are to be performed in future to the extent value of ₹900 lakhs. But since the company's position is not good, company has resigned it or is being cancelling the contract, due to which it has to settle the same contract by paying a penalty of ₹72 lakhs. Also, my dear children, since contractual commitments is purely similar to contingent liabilities which are not recorded in the books of accounts, these were also to be routed through capital reduction account, something like reconstruction of capital reduction account debtor, reconstruction or capital reduction account debtor to cash or bank account 72 lakhs. You are required to pass the journal entries for all the transactions related to internal reconstruction, prepare capital reduction account and bank account, and prepare notes to accounts on share capital and PPE immediately after implementation of internal reconstruction. Bacha, asking journal entries, capital reduction account and bank account, asking you to prepare, not asked to prepare balance sheet if you observe, he is just asking you to prepare share capital and PPE. Points that ought to be noted here, if at all any reserves and surplus are given, then any reserve can be utilized for the scheme of internal reconstruction since it overrides each and every act. So if at all capital reserve, securities premium, what not the things are there, then you can automatically write off those things and the same can be transferred to the scheme of reconstruction. That is point number 1 that could be appreciated, but here it is not there. And as I already told you that freehold property is given for debentures. So also take care about that point, because even that is also a bit different, but in this problem even that problem is also not there, since book value is exactly equal to agreed value. If book value is not exactly equal to agreed value, first of all you have to revalue and then the same must be given to the debenture holders. And if at all you are preparing a balance sheet, then take care after the heading you have to keep unreduced or as reduced, that's mandatory. So take care. That's all about question number 7. Question number 8, liquidation of companies. Debit and credit balances of Blossom Limited as on 31/12/2021 were as follows. Debit balances and credit balances, land and building, other fixed assets, inventory, trade receivables, surplus, negative balance. Take care, surplus is nothing but P&L account having negative balance, something like huge losses. Yeah, just a minute, I'm sorry. So coming to question number 7, after doing all the adjustments, you have to prepare capital reduction account, and whatever the balance of capital reduction account is there, you have to utilize the same to write off the accumulated loss of 783 lakhs. So this accumulated capital reduction profit must be used for writing off of this 783 lakhs of accumulated huge loss, and then if any balance is there, it has to be transferred to capital reserve account. So I just have forgotten to tell the same. And coming back here to question number 8 of liquidation, surplus, negative balance, and which is nothing but P&L account. Likewise, your previous question, internal reconstruction, how negative balance, accumulated surplus is there, in the same way the same statement also. Credit balances, share capital, 8,000 preference shares of ₹100 each, 12,000 equity shares of ₹10 each, bank loan, 8% debentures, outstanding interest on debentures, and trade payables. It's been a tradition that from liquidation, the first preference to ask a question is all about statement of affairs. Take care, not statement of affairs, statement of liquidator's account. I mean to tell liquidator's final statement of account. It's been a tradition that statement of affairs is not at all being tested in the examination, because that is just a format based. A person who is capable of by-hearting can comfortably answer that. So generally board will not test you in that area. Till now it is not tested, but if tested you have to take care. And even this is also liquidator's final statement of account. Company went into liquidation, so prepare liquidator's account after considering the following. Liquidator's expenses 3000, liquidator's remuneration 10,000, again bacha. Because if he has given at least percentages, then we might have something to compute, but here directly given its liquidator's remuneration and hence nothing to compute at all. Bank loan was secured by pledge of stock. So bank loan is having security with respect to stock. Okay. Debentures and interest thereon are secured by floating charge on all the assets. So debentures and interest is having a charge secured on all the assets. Fixed assets were realized at book values and current assets were realized at 80% of book values. Problem is over. So liquidator's final statement of account, you have to draft all the receipts from the assets and all the settlements or payments to the liabilities, and then you have to repay to the capital holders. Also, these two things were fetched the book values, and these two things, since being current assets, fetched at 80% of the values, and you have to settle all these things first. But before settling all the outside liabilities, you first have to pay the liquidation expenses and liquidator's remuneration and start settling the liabilities. While settling the liabilities also, first you have to settle secured fixed, that is nothing but here it's bank loan, since it is having a fixed charge on a specific inventory, and next secured floating, but before that preferential unsecured must be settled, but they were not there at all, and hence secured floating 8% debentures and interest, the whole 1,08,000 must be settled, and then unsecured non-preferential trade payables 4 lakhs must be settled. After repaying to these parties, you have to repay to the preference share capital, and if any deficit or surplus, after repaying to the outside liability holders, the remaining amount must be given to preference holders. If any deficit is there, they have to bear that, and of course equity will not get a single penny also. Even if there is some surplus after distributing to preference shareholders, whatever the leftover will be taken by equity shareholders, whether it is more or less. Even in this problem, there is no concept of computing deficiency per share, how much each and every shareholder has to pay and how much we have to pay them, because that is also not at all necessary here, since 12,000 equity shares, rupees 10 each, which implies that everything is fully paid up, and also there are no two different classes. At least if there are two different classes of equity shares, then we could have a problem to compute. Problem might be a bit typical, but now problem is not at all typical. Everything is pretty easy. Anyways, that is the end of question number 8. And question number 9, NBFCs. XYZ Finance Limited is a non-banking finance company. The extract of its balance sheet are as follows. Equity and liabilities, paid up capital, general reserve, non-current liabilities, loans, deposits, assets, non-current assets, property, plant and equipment, investments in shares and shares of subsidiary companies and in debentures of group companies, current assets and cash and bank balances. You are required to compute net owned fund of XYZ Finance Limited as per NBFC, systematically important non-deposit taking companies and deposit taking company directions of RBI 2016. First of all, remember my dear children, there are two kinds of NBFCs. NBFC, deposit making companies, non-deposit companies. Again under non-deposit, SI, NSI. First, you just remember that there are no different styles of computations of net owned funds for NBFC D companies, NDSI companies and NENSI companies. For each and every NBFC, net owned funds computation is obviously same. And let's start computing the net owned fund. But before computing the net owned funds, first of all, you have to compute the owned funds. So while going with the owned funds, take care my dear children. Here it's pretty simple. Equity share capital paid up plus reserves and surplus minus there are no fictitious or miscellaneous assets, and also there are no intangible assets, and hence just adding of these two things will be giving you the own funds, which is 800. From this you have to deduct investments. Again, coming to investments, while computing net own funds, two kinds will be there. Number one is investment in equity shares of subsidiary companies, that is 250, has to be deducted totally, and investment other than shares of subsidiaries or group companies will be deducted to the extent of in excess of 10% of owned fund. Now our owned fund is 800. 800 multiplied by 10%, which comes to 80. So in excess of 80, 400 is equal to rupees 320. And hence you have to deduct rupees 320 from that own fund in order to make it a net own funds. So 800 minus 250 minus 320 will be your final answer for the computation of net own fund. Pretty simple problem. And next, banking companies, question number 10. Again, my dear children, in banking it's been tradition that balance sheet is generally not posed in the examination, but if posed you have to take a bit more care. Anyways, just by observing this, I could conclude that is asking to prepare P&L account itself. Anyways, let's see the same. The following are the extracts of figures from the books of Top Bank Limited as at 31/3/2022. Interest and discounts received, interest paid on deposits, issued and subscribed capital, salaries, allowances, directors' fees, allowances, rents and taxes, postage and telegrams, statutory reserves fund, commission, exchange and brokerage, rent received, profit on sale of investments, depreciations on bank properties, statutory expenses, preliminary expenses, and auditors' fees. Following further information is given. Just by observing the data, I'm pretty sure that he is just asking us to prepare P&L account because there are no elements with respect to balance sheet. So prepare P&L account of Top Bank Limited for the year ended 31/3/2022, and let's continue. But to prepare P&L account you need some schedules, and the schedules are all about up to 12 schedules. Up to 12 schedules it is in balance sheet, but in P&L account it will be starting with schedule number 13. Schedule number 13, 14, 15, 16 and finally working note number 1. What is schedule number 13, sir? So schedule number 13 is nothing but interest and discount earned. Schedule number 14, other income. Schedule number 15, interest expended. Schedule number 16, other or administration expenses. And coming to working note number 1, nothing great. It's something like provisions and contingencies. For provisions and contingencies, there is no specific schedule in banking, and hence all the provisions will be clubbed and disclosed at one place, which is generally nothing but working notes or notes to accounts. Anyways, here it's nothing but working note number 1. So let's classify the schedules first. Interest and discount received, schedule number 13. Paid on deposits, schedule number 15. Issued and subscribed capital not necessary for P&L account, but it will be there in schedule number 1. Salaries and allowances, administration expense 16. Directors' fees and allowances 16. Rents and taxes paid 16. Postage and telegram 16. Statutory reserve fund is a reserve. So it's not affecting P&L account, but it will affect reserves and surplus, which is nothing but schedule number 2. Commission, exchange and brokerage, it's a kind of income to the banker but falls under other income, and hence it will be under schedule number 14. Rent received, schedule number 14. Profit on sale of investment, schedule number 14. Take care with this area. Even if there is loss on sale of investment also, it has to be booked only in schedule number 14 itself by way of deducting the same from the profits. So my intention is all about, if there is profit on sale of investments, profit on sale of fixed assets, the two elements must be deducted with respective loss on sale of fixed assets and loss of sale of investments. And also if any foreign exchange gain or loss is there in the same schedule, by setting off you have to adjust the same. And depreciation on bank property, of course it is an administration expense, schedule number 16. Statutory expenses 16, preliminary 16, auditor's fees 16. These are the schedule numbers. Let's go with the further information. A customer to whom a sum of rupees 16 lakh has been advanced has become insolvent and it's expected only 40% can be recovered from his estate. So my dear children, it is purely nothing but an adjustment given with respect to provision. So take care, totally 16 lakhs, and he had become insolvent and the total due is 16 lakhs. We are expecting only 40% can be recovered. So automatically remaining 60% is nothing but bad debt, and hence you have to create a provision for bad debts to the extent of that 60%, which is nothing but 16 lakhs into 60%. That will become provision, which is in working note number 1. There were also other debts for which a provision of rupees 2,10,000 was found necessary by the auditors. Even the same, which has to be considered in working note number 1, since it is a kind of provision. Rebate on bills discounted on 31/3/2021 was rupees 19,000 and 31/3/2022 was rupees 25,000. Take care, this rebate on bills discounted is purely similar, is purely an adjustment which has to be done in schedule number 13 for interest and discount. If you have remembered the concept of rebate, opening rebate has to be, opening rebate is nothing but current year income. In current year discount, there is some sort of unearned portion which is called as current year rebate, which is next year discount or next year income. And hence, my dear children, take care with respect to that adjustment, that opening rebate of 19,000 has to be added and closing rebate of 25 has to be deducted. So 59,29,180 plus 19,000 minus 25,000 will be giving you the net figure which has to be taken and booked in P&L statement. Preliminary expenses were to be written off fully during the year. Whether or not given this statement, we will do the same in schedule number 16. Provide 9 lakh for income tax, which is nothing but provision for tax, which will be in working note number 1. So totally as of now, we have got 3 provisions: 16 lakhs into 60% plus 2,10,000 plus 9 lakhs are the total provisions till now. Opening profit and loss account was nil as on 31/3/2021, and he is of course asking you to prepare P&L account. So opening P&L account is nil and hence no need to do any further adjustments. Reason being, after completion of schedule number 13, 14, total income 15, 16 and working note number 1 for provisions and contingencies, total expense you will get, and finally current year net profits from the operations. Take care, my dear children, it has to be added originally to the opening balance of P&L statement. So for opening balance of P&L account, you have to add current year net profit, and also, my dear children, after completion of the same, again you have to deduct current year appropriations. Whether or not given, my dear children, out of current year net profit, 25% of current year net profit has to be transferred to a specific reserve called statutory reserve. And finally, at the end, you're going to get the closing balance. And my dear children, the same is absolutely here is not necessary. Reason being, yes, perfect. Reason being, opening P&L account is not given. So this much appropriation is not needed. Opening balance you can eliminate. Current year net profit minus 25% of current year net profit, which is nothing but closing balance, which is transferred to schedule 2 reserves and surplus in balance sheet. Anyways, that is the end of question number 10 with relates to banking. And now we need to start with consolidated financial statements, question number 11. On 31st March 2022, H Limited and S Limited gives the following information. H Limited, S Limited, equity share capital authorized, issued, subscribed and paid up in equity shares of rupees 10 each, fully paid up, general reserve, P&L account, trade payables, provision for tax, other provisions, plant and machinery, furniture and fittings, investment in equity shares of S Limited, inventory, trade receivables, cash and bank balances, sundry advances, of course debit. Anyways, so if you observe, up to this stanza, it was being appeared as liabilities, and after that it is being appeared as assets. Okay, so let's continue. Sir, it's recommended, of course not very much required, but it's recommended in order to boost some sort of confidence for doing the problem. Whenever some sort of raw balance sheet is given in the question, check whether the assets are exactly equal to liabilities or not. before starting the problem. Of course, not at all mandating, but just it's been a small advice. Because in some chapters like internal reconstruction, he wantedly gives a wrong balance sheet where you have to modify it correctly. Anyways, let's continue with the additional information that is available. H Limited purchased 90,000 equity shares in S Limited on 1st April 2021, at which date the following balances stood in the books of S Limited. So, first of all, H Limited book purchased 90,000 equity shares in S Limited. In S Limited, there are 2,400,000 divided by 10 rupees, which is nothing but 2,40,000. 90,000 divided by 2,40,000 into 100, which comes to 37.5%. So, of course, holding interest in the sense minimum there should be more than 50%, but here there is 37.5%. So, which may not be correct till now, but we need to check out what happened and why it is happened. Anyways, as on the date of acquisition, the balances of the books of companies with respect to the reserves of S Limited of general reserve to the extent of rupees 1,500,000 and P&L account is rupees 633,000. Okay. So, general reserve closing, how much is given here? 690 and 810. Closing is something like 690 general reserve and 810 is P&L account. But opening general reserve is 1500, opening P&L account is 633. So there might be some adjustment to general reserve for sure. Anyways, let's check out. On 14th July 2021, S Limited declared a dividend of 20% out of its pre-acquisition profits. H Limited credited the dividend received to its P&L account. Of course, a very common adjustment. Without this adjustment might be consolidated balance sheet problem is not there. Anyways, let's continue. S Limited, of course subsidiary, declared a dividend of 20% out of its pre-acquisition profits. Check out the pre-acquisition profits. First of all, what do you mean by pre-acquisition profits? So, pre-acquisition profits are nothing but before acquisition, whatever the profits are there, those are pre-acquisition profits. H Limited acquired on 1st April 2021. So, before 1st April, that is, I mean to tell, opening P&L account, that is 633 is pre-acquisition profits. From these pre-acquisition profits, S Limited is declaring a dividend and H Limited received the dividend and credited the same to P&L account, which is a thrash. If the dividend is declared out of pre-acquisition profits, it is nothing but pre-acquisition dividend, which has to be adjusted to cost of investment as it is a capital item, but he has done totally reverse by treating as if it is a revenue item. My dear children, one more thing that could be appreciated here is that dividend is declared on 14th July 2021 for the financial year ending 31st March 2021. That could be an implied meaning. So, for the year ending 31st March 2021, H Limited declared dividend, S Limited declared dividend on 14th July 2021. So, anyways, it's a capital item which has to be adjusted to cost of investment, but H Limited wrongly adjusted to P&L account, credited to P&L account. So, now what you have to do? In step number 5, while computing cost of control, you have to deduct pre-acquisition dividend from cost of investment. I mean to tell, what is the cost of investment given here? 1500 lakhs. You have to deduct pre-acquisition dividend from this 1500 lakhs. And also, since it is credited to P&L account, but it should not do like that. While doing the same in step number 7, that is consolidated reserves and surplus for consolidated balance sheet. At that time, you just have to deduct the same. So, 2 adjustments were to be given for pre-acquisition dividend, which is wrongly treated. Anyways, dividend that is received by the holding company is all about 90,000. On 90,000 shares multiplied by 10 multiplied by 20%, that is rupees 1,80,000 is the dividend that is received by H Limited. But how much is declared by S Limited? Will it be declared on the entire 2,40,000 shares? Let's check out for the same, which is given in the next point. On 1st November 2021, that is during the current year, S Limited issued 3 fully paid up equity shares of rupees 10 each for every 5 shares held as bonus out of pre-acquisition general reserve. So as I told you, there might be some adjustment to this 1500,000, right? That adjustment is given here in point number C. Bonus declared. Opening is 1500, which is nothing but pre-acquisition. From that pre-acquisition, company has declared bonus shares. Take care. Current year ending is given at 31st March 2022 from 1/4/2021. During the year, that is somewhere in November 2021, company has declared bonus issue. So one thing that could be appreciated here is that as of 31st March 2022, you are having 2,400 or 2,40,000 equity shares. That is after November 21, which is nothing but after bonus issue. So after November 21, that is after declaration of bonus issue on 31st March 2022, that is at the end of the year. That is at the end of the year, 2,40,000 equity shares are existing in the balance sheet of S Limited, which is nothing but closing balance of equity shares including bonus shares. So I would like to write the same. For every 5 shares, 3 are the bonus and finally 8 are the total shares. This is as on 31/3/2022. This is in November 2021. This is on 1/4/2021. And also, my dear children, subsidiary company totally is having 2,40,000 on 31/3/2021. So how many would be the bonus? Just do the cross multiplication. 2,40,000 multiplied by 3 divided by 8, which comes to 90,000 equity shares. And also, so original will become 2,40,000 minus 90,000, which comes to 1,50,000. This is what with respect to subsidiary company's shares. And holding interest. Take care, my dear children. Holding company purchased 90,000. One second. Yes. Holding company purchased 90,000 equity shares as at 1st April 2021. 1st April 2021, that is all about 90,000. Out of this, 1,50,000. And also it will receive bonus for sure. That is 90,000 into 3 by 5. Bonus shares 54,000. On a whole, it is having 90,000 plus 54,000, 1,44,000. Total number of shares now which were held by holding company. So fine, my dear children, check out the total. Holding interest now. 90,000 divided by 1,50,000 into 100, which comes to 60%, or 1,44,000 divided by 2,40,000 into 100, which comes to 60% again. So this is a correct comparison, either 90 to 150 or 144 to 24.4. But we have compared, in order to get the answer, something like we have compared 90,000 to 2,40,000, 90,000 by 2.4. So how could we get the answer? Of course, we got 37.5, which is wrong. So now one more point that could be appreciated here is all about that. My dear children, take more care that subsidiary company is declaring dividend for the year ending 31st March 2021 on July 21 for this 1,50,000 shares, but not on 2.4. Since it is not having those number of shares, it is having only 1,50,000 shares. It will declare dividend only on 1,50,000. So 1,50,000 into 10 into 20%, that is 3 lakhs is the total dividend which is declared out of P&L account, that is 6,33,000. So finally you have to do general reserve, closing balance, opening and current year. After deducting bonus, you will get a balancing figure which is nothing but current year reserve, and P&L account same, opening, current year. After deducting pre-acquisition dividend which is declared on 1,50,000 shares, take care, you are going to get balancing figure which is relating to current year profit. One more thing that could be appreciated here is all about pre-acquisition dividend received by holding company is on 90,000 shares, but it is wrongly treated and hence it has to be deducted from cost of investment, that is 1500,000 in step number 5, cost of control, and in step number 7 while computing consolidated reserves and surplus from consolidated P&L account. Last and final adjustment, it seems, of course details are there. Anyways, on 31st March 2021, the inventory of S Limited includes goods purchased for 50,000 from H Limited, which it made a profit of 25% on cost. Take care, S Limited goods include purchased from H Limited. So holding company is selling to subsidiary company, which is literally nothing but downstream. Holding is selling to subsidiary, which is literally nothing but downstream. So anyways, purchased for rupees 50,000 from H Limited. So cost price to H Limited is nothing but 50,000, which is nothing but selling price to H Limited, which comes to an amount of rupees 50,000, and profit made is 25% on cost price to H Limited. So 25% on cost price is nothing but 25 by rate by 100 plus rate, that is 125 on selling price, which is nothing but 20% on selling price. So on 50,000 it made a profit of 20%, and which is nothing but intercompany transaction or elimination of unrealized profit. So that has to be eliminated from inventory, and also the same is to be eliminated from holding company profit since it is downstream. So this is what the adjustment relating to point number D. And point number E, details of trade payables and trade receivables are as under: bills payable, creditors, debtors, bills receivable. Okay. Prepare a consolidated balance sheet on 31st March 2022. Pretty simple now. So for preparing consolidated balance sheet, you have to do all the steps. There is no difficulty here. Take care, if holding interest is 60%, minority will become 40. Points that you need to understand here is all about dividend with respect to bonus issue. Since bonus is there, compute carefully bonus, dividend, and also percentage of acquisition. If you have not considered point number C, or if you did not do point number C properly, your entire problem will go flop. So this is the major element that you need to consider in this problem. Apart from that, everything is pretty easy. Anyways, my dear children, that is what your consolidation till question number 11, wherein we have completed with all the problematic related things in accounting in advanced accounts. So from the tomorrow's session, we are going to start accounting standards. Of course, as I said, we'll have some detailed explanation and also solving the solutions for accounting standards. So let's start our discussion with accounting standards. Question number 1, that is like case 4, question number 12. Explain the accounting treatment of contingent gains as per case 4, contingencies and events occurring after balance sheet date. My dear children, contingent gains, strictly speaking, were transferred to from 1/4/2004. These were transferred to accounting standard number 29. But even though it is being dealt in accounting standard number 4, to such part which are not dealt by accounting standard number 29. Anyways, strictly speaking, accounting standard number 29 deals with provisions, contingent assets and contingent liabilities. But another word for contingent asset is nothing but contingent gains. Of course, some sort of thin line of difference will be there, which is absolutely not needed for us now. Anyways, let's continue with contingent assets as per AS4. All the time from accounting standard number 4, he will be asking two familiar kinds of question like creating of a provision after the balance sheet date and dividend, declaration of dividend. But this time he has changed with respect to the question in RTP and had to ask one direct theoretical question. Pretty simple. Point number 1, contingent liabilities gains are not to be recorded in the books of accounts since violation of prudence concept, but exception, if the gain is virtually certain, you can absolutely recognize the same. Contingent gains are not to be recorded since the recognition of revenue which may never be realized, which is nothing but violation of prudence. Of course, if it is a virtually certain and it is not a contingency, and you can recognize the same. Next, AS5, question number 13A. Bela Limited has a vacant land of 20,000 square meters which it had no intention to use in the future. Company decided to sell the land to tide over its liquidity problems and made a profit of rupees 10 lakh by selling the land. So this is transaction number 1, sale of land. Strictly speaking, sale of land is relating to ordinary course of business itself, because ordinary course of business, sale of land is quite common, but it is not a day-to-day activity. Once in a while we are having that, and hence, my dear children, it will become an exceptional item even though it is relating to due course of business due to its size, nature and incidence of the transaction. But check out the purpose for what Bela Limited is selling the land: in order to tide over its liquidity problems. Bela Limited is into some liquidity crunch, having huge liquidity problems where no enough cash is there in order to run the business and to repay the liability holders. And in order to consider that thing, we have sold the land where we are not having intention to use in future at all. So, even though sale of land is an exceptional item, purpose of sale of land is totally different. That is to tide over or to overcome liquidity crunch or liquidity problems. And hence, my dear children, now this is not sold in ordinary course of business. This is sold for an extraordinary item to overcome liquidity crunch, and hence automatically it will become an extraordinary item but not exceptional item. Simple rule: purchase and sale of assets or sale of assets is an exceptional item. Exception. Sale of asset for some special or extraordinary item like tiding over the liquidity problems is an extraordinary item. Take care. Anyways, profit from sale of such asset is like rupees 10 lakhs. Moreover, there was a fire in the factory, and a part of unused factory shed valued at rupees 8 lakhs was destroyed. So we are running a factory and some part of factory is destroyed by the fire, and loss from fire of factory is all about rupees 8 lakhs. Of course, loss due to fire, which is also an extraordinary item. As per accounting standard number 5, if it is an extraordinary or exceptional item, these items must be presented and disclosed separately. But what the company has done, loss from fire was set off against profit from sale of land, that is like 10 lakh profit minus 8 lakhs loss, and finally a net profit of 2 lakhs was disclosed from sale of assets. Do you agree with the treatment? Obviously no. Since they fall for exceptional, since they fall for extraordinary items, these must be presented and disclosed separately. Of course, the same rule is applicable even to exceptional items also. Whether exceptional or extraordinary, setting off is not possible. You have to present and disclose separately. So, take care. In the given case, disclosing net profits by setting off fire losses against profit from sale of land is absolutely not correct. These ought to be disclosed and presented separately. Moving on to the next thing, accounting standard number 7, 13B. On 1st December 2020, Sampath Construction undertook a contract for rupees 108 lakhs. So, contract revenue is equals to rupees 108 lakhs, and it was found that already spent 83.99 lakhs on the construction. This is total contract revenue. This is incurred contract costs. Incurred. Prudent estimate that additional work to complete is all about 36.01. So this is future estimated cost. You are required to compute the amount of provision for foreseeable loss which must be made in final accounts for the year ended 31st March 2021 based on AS7. So let us start. First, let us compute percentage of completion. Percentage of completion is equal to contract cost incurred divided by total estimated contract cost, that is equal to rupees 86.9983, right? I'm sorry, 83.99 by 83.99 plus 36.01 is a total estimated cost. So let's just find the same. So 83.99 plus 36.01, totally 120. So 120, I'm sorry, 86, 83.99 divided by 120 into 100. Yeah, I can take it as 70% on a whole. Percentage of completion is like 70. So let me go with contract account now. Total contract revenue is 108 multiplied by 70%, 75.6, and contract cost is all about 83.99. But let us also find the total estimated loss. Total estimated loss is equal to total contract revenue minus contract cost. Total contract revenue is 108 minus total contract cost is 120, and hence loss will be 108 minus 120, which comes to 12. So here to net loss will be 12 on a whole, but check out the balancing figure, which is nothing but provision for loss. Already we have recognized 75.6 minus 83.99. 75.6 minus 83.99. We have reported a loss of 8.39. But now the total loss is like 12 lakhs, and hence still you need to recognize 3.61 as your provision for loss. It is as simple as such. So total loss is like 12 lakhs. Has done it very simply, but if you want, you can also further extend the same, something like total loss is 12 lakhs and provision is 3.61 lakhs. That's it. And question number 14, AS9, revenue recognition. When will the revenue be recognized in the following situations? When the purchaser makes a series of installments payment to the seller and the seller delivers the goods only when the final payment is made. This is relating to sale of good. Generally for sale of good, when the transfer of ownership is done, we are going to record the same in the books of accounts. In this situation, customer is paying it in series of installments and we will deliver the goods only when the final payment is made. So after two situations, we need to recognize the revenue in general after the final payment is made and the good is delivered. Exception, if the customer makes substantial payment and for the unpaid portion, there is confidence on the customer with respect to the seller that the customer will pay. And if we have delivered the goods and the ownership is transferred, even after when the final payment is not done, you can recognize. Listen, after final payment is made and after delivery is made. But even though the final payment is not yet completed and substantial deposit is made, and for the unpaid portion, we are having confidence that the customer will pay, and now the sale is consummate, sale is absolute, that it will happen and he will pay, and hence we are delivering the good. In this situation, even though the final payment is not done, since we have delivered the good by having confidence on the seller, you can recognize the same. Where seller concurrently agrees to repurchase the same goods at a later date, it is not at all dealt as per accounting standard number 9. It will be dealt as per accounting standard number 19, a kind of sale and lease back, and hence revenue will not be recognized at all. When the goods are sold to distributor or dealers to others for resale, again sale of good. I'm selling goods to the outsiders. If the ownership is transferred immediately, it has to be recognized immediately. If the sale is subject to return of unsold stock, I mean to tell, if the dealer has unsold stock, he will be returning the same to me. In such a case, I have to wait till the dealer sold to the third parties for recognition. Generally, when the ownership is transferred, if the sale is subjected to return of unsold stock, you have to wait till the dealer sold to the third party. Commissions on service rendered as an insurance agent on business. Of course, this is nothing but rendering of service. Pretty simple. If it is a new policy, after the commencement of the policy. If it is a renewal policy, after the renewal date, effective renewal date is done by the insurance company. At that time, insurance agent can recognize his commission. So that is what 14, 1, 2, 3 and 4. Now let me go on to the next thing. A17, question number 15. A company has inter-segment transfer pricing policy charging at cost less 10%. Market prices are generally 25% above cost. Is the policy adopted by the company correct? Say a company is having segment A and segment B. Segment E is having an output where the market price is cost price plus 25%. But segment A is transferring to segment B at cost price minus 10%. Is the policy adopted by the company correct? That is the question. Answer. Who are you to decide that the policy adopted by the company is correct with respect to the price fixation? Obviously nonsense. So they can do this, they can do so. If they need, they may disclose additional information why they have done so. Otherwise, nothing is needed. What the policy adopted by the company is absolutely correct. But take care, you just need to reproduce the terminology. So just go through the solution carefully. And but very important thing, whatever the policy you follow, disclose the same and apply the same consistently. This statement is very important in the entire answer. And moving on to the next thing, is 18, question number 16, pretty easy. SP Hotels Limited entered into an agreement with Mr. A for running its hotel at a fixed return payable to the latter every year. So there is Mr. A. Hotel is belonging to Mr. A. SP Hotels Limited entered into an agreement with Mr. A that A's hotel will be taken over by SP Limited and SP Limited will be running the hotel. And they will be paying some fixed amount of return to Mr. A every year. Contract involves day-to-day management of the hotels by Mr. A, while all the financial and operating policies will be taken by the board of directors. A is also not having any voting power in SP Hotels Limited. Would he be considered as a related party? No, because a hotel belongs to A, say me. One other company had come and it had taken the hotel and it is giving me some fixed return every year. I don't have any right to participate in the financial and operating decisions that were involved. I was just supposed to employ like an employee to see the day-to-day operations. So, my dear children, Mr. A is not a relative of SP Hotels Limited since he is not having any power in SP Hotels Limited. Case 19, leases. Win Limited has entered into a 3-year lease agreement with Thania Sports Club in respect of fitness equipment costing 1699,999.5. Take care, don't consider it as 17 lakhs. If you have taken this one, you will get the round figures perfectly. Moreover, it was given in the question, you don't change the figures that were given in the question. Annual lease payment must be made at the end of the each year or structured in such a way that sum of present values of the lease payments and that of residual value together equal the cost of the equipments that were leased out. So he did not give what is the annual lease payment. He is asking us to compute annual lease payment, which is literally nothing but present value of lease payments and that of residual value together will equal the cost of equipments that were leased out. Simply like, as of now, you are purchasing the equipment for 1699,999.5. This is outflow to you now. Of course, at year 0 and continuing, UGRV of the equipment after the expiry of lease period is 133,500. Take care, UGRV at the end of year 3 is 133,500, but you are at year 0. This is outflow, but we are having an inflow in the form of UGRV. So bring year 3 value to year 0. That is 133,500 multiplied by year 3 discounting factor 0.751. 133,500 into 0.751, which comes to 258.5 minus 258.5. Take care, this is outflow, this is inflow, and hence I am deducting the same. So 258.5 minus 1699,999.5, which comes to, oh, 1 second, wrong, 258.5 minus 1699,999.5. Fine, we have got something like 1599,741. 1599,741 done. That is what net cash outflows at year 0. Now, assets would revert to the lessor at the end of the lease. So, would revert in the sense which is nothing but finance lease. Given that the IRR or interest rate is 10%, compute annual lease payment and UEFI where the discounting factors are absolutely given. So, let's continue. So, I need to collect an amount of rupees 1599,741, which is nothing but the total present value of cash outflow over 3 years. But this is present value of cash outflow, 3 years is future. So let us bring it to present value, which is nothing but where is this one? Yes, 0.909 plus 0.826 plus 0.751, totally 2.486. 2.486. So now even this is also present value. If you're doing 1599,741 by 3, then it will go wrong again. Reason being, this is present value, 3 years is future years. Anyways, so that we have got 1599,741 minus 2.486, which comes to 1599,741. Oh, sorry, 1599,240. I'm sorry. Let's start. 1599,741 divided by 2.486. Yes, exactly 643,500 is the lease payment per year. Now he told that since the asset would revert back, you need to find what is the unearned finance income. UEFI is equal to gross investment in lease minus present value of gross investment in lease. So GIL is nothing but MLP plus UGRV. MLP 643,500 multiplied by 3 years plus UGRV 133,500 minus present value 643,500 multiplied by 2.486 plus 133,500 multiplied by present value 0.756, which comes to 643,500 multiplied by 3, 1930,500 plus 133,500, which is nothing but 20,64,000 minus, if you have done this total, you are going to get 1699,999.5. If you need, you can check out. So this minus 1699,999.5, which will be fetching you 364,000.5, which is nothing but your UEFI. That's it. Pretty simple. Listen, what you have to do is all about first net cash outflow, that is cash outflow at year 0 minus present value of cash inflows with UGRV. You will get one figure divided by present value of 3 years, that is by adding these 3 years you are going to get MLP. If you have got MLP, you can do everything very easily. MLP plus UGRV is nothing but GIL. Present value of GIL is nothing but bring the same to the present values by multiplying with the factors. That's it. Now, ACE 20, question number 18. Following information relates to XYZ Limited for the year ending 31st March 2022. Net profit for the year, number of equity shares, rupees 5 lakhs, 10 rupees each outstanding. So 50,000 are the number of shares. Convertible debentures issued by the company at the beginning of the year. Okay. 8% convertible debentures 50,000. Equity shares to be issued on conversion were 55,000 in future. Income tax rate is 30%. Compute basic and diluted. Very easy. Basic is very easy first. 37,50,000 by 50,000. Very simple. So 37,50,000 divided by 50,000. 37 50,000 divided by 50,000. 75 is basic, diluted. So whenever there are no debentures, interest will increase, and after tax, because if interest is not there, profit will increase. If profit will increase, you have to pay tax. If interest is not there, interest decreases, profit increases. If profit increases, you have to pay tax. So let's find the same. 37,50,000 is the net profit after tax. Add back with interest after tax. Interest is nothing but 50,000 into 100 into 8%, which comes to 4 lakhs. But tax is like 30%. So 4 lakhs minus 30%, which comes to 2,80,000. Okay. So plus 2,80,000. So 37,50,000 plus 2,80,000 is the total earnings. 37,50,000 plus 2,80,000, or the total earnings 40,30,000 divided by total shares will be 50 plus 55, 1,05,000, which comes to 38.38 is nothing but your diluted earnings. Okay, just wait. Even basic has considered 5 lakhs, but given here number of equity shares is rupees 5 lakhs. It's obviously a kind of printing mistake, because given here like rupees 5 lakhs, but given number of equity shares, so rupees should not be there. Anyways, so he has considered 5 lakh equity shares, but take care, it's some sort of printing mistake. In your main examination, obviously you will not be having that confusion at all. He should not give rupees here. Number, so 5 lakhs, that's it. So anyways, hope you have understood the methodology, like how to do. That is the end of question number 18. Very simple. AS22 asked with some definitions. Accounting income or loss, taxable income or loss, tax savings and tax expenses. Accounting income or loss is nothing but profit or loss computed as per P&L account. Taxable income or loss is nothing but as per applicable tax laws. Taxable expenses is nothing but total of CT plus DT. I mean to tell CT plus DTL or CT minus DTA. Simply you can write CT plus or minus DT. Very simple. Next, AS24 discontinuing operations. What are the disclosure requirements of interim financial reports as per AS24 discontinuing operations? People will not take it seriously, but interim financial reports discontinuing operation disclosure is pretty simple. Right from the reporting period ending till the interim financial reporting date, whatever the disclosures are there, initial disclosures, subsequent disclosures, other disclosures, every disclosure should continue. So take care. Interim financial reporting, including significant activities or events from the most recent reporting period till the discontinuing operation, and significant changes in cash flows with respect to assets and liabilities must be disclosed as per AS25 linked to AS24. You have to write two statements very carefully, something like assets and liabilities if sold or settled right from the most recent annual period till the reporting date. That is the first one. And second one, significant activities or events occurred from the most recent annual reporting date till the reporting date of interim financials has to be considered. AS26. Okay. 20A. K Limited launched a project for producing product X in October 2021. The company incurred 40 lakhs towards research and development expenses up to 31st March 2022. Due to prevailing market condition, management came to conclusion that it cannot manufacture the product and sold in the market for the next 10 years. So it would like to defer the expenditure and write off in future. Advise the company as per applicable accounting standard. Sir, if you observe, we cannot manufacture, market and sold the product for the coming 10 years, for the next 10 years at all. So in the next 10 years, I cannot do anything, and hence it is not at all satisfying the requirements of capitalization, because it is not initially generating future economic benefits at all. Why to go with the development phase conditions? Because prima facie asset definition itself is failed here, and hence whatever the expense that we have spent has to be charged to P&L account. It cannot be taken to balance sheet and it cannot be deferred in its P&L account, which is wrong. It has to be charged totally to P&L account in the same year of incurring itself. So take here, if you observe, he will be giving development phase conditions, but what my main intention is that prima facie asset definition itself is not satisfied and hence charged. But since it is AS 26, you can also write development phase conditions are not satisfied and hence you will be charging the same to P&L account. Next, question number 420B, AS 29, I guess the last and final question. Chaos Limited is in the process of finalizing the books of accounts for the year ended 31st March 2022. It seeks your advice in the following cases. Chaos Limited entered into an agreement to supply 1 lakh face masks to D Limited by 30th April 2022. Failing it, have to pay a penalty of rupees 10 per item which was not supplied. On 31/3/2022, it could supply only 50,000 face masks to D Limited by 30th April 2022. My dear children, first of all, you understand you have to create a provision only for a present obligation but not at all a future obligation. So here the ending date is something like 30th April 2022. Your estimation is not needed to me. Current year ending is 31st March 2022. Still there is enough time to manufacture. Who knows what magic can happen in the next month? So remaining production might be stopped and you might need to pay as per the agreement itself. So that is not in your hands. Moreover, you are just at 31st March 2022 and the ending date is 30th April 2022, which is not at all a present obligation and hence obviously no provision is required at all. So point number 2, Chaos Limited has filed a court case in 2014-15 against its competitors. It is evident that the lawyers that Chaos Limited may lose the case and would have to pay rupees 3 lakhs being the cost of litigation. No entries for provisions have been made in the books. So already court case is filed in the year 2014-15. My judgment, my lawyer panel were been telling that we are going to lose the case, due to which you have to pay rupees 3 lakhs as cost of litigation. So it is obviously known. If at all, if the obligation is done, is it a present obligation or not? First of all, of course it is a present obligation, since we know that we are going to lose the case. It is already happened. But if you see point number 1, the date is like future, ending date is like future. It is not at all a present obligation. But in point number 2, already court case is filed. It is a present obligation and hence you have to create a provision. Provision should be made to the extent of rupees 3 lakh, for which the amount is required to settle the obligation. A new regulation has been passed in 21-22 by the Healthcare Ministry to upgrade the facilities. Deadline is 31/3/2023. The company estimates that 10 lakh is needed for the said upgrade. Of course, since deadline time is there, huge time is there, which is not at all a present obligation and hence no provision is obviously required, since it is relating to future date. Kindly give your answer for each of the above with proper reasoning according to the relevant accounting standard. State the principles for recognizing a provision. Literally, like you have to write the definition of the provision. Present obligation, outflow of resources should be probable and reliable estimate can be made. So that is the end of your RTP discussion, my dear children. Once again, I'm telling, take care, never ignore a minimum of past 3 attempts RTP, including current attempt. So totally you need to revise 3 attempts, current attempt and past 2 attempts, where you can get 15 marks out of 25 to 30 marks that were being posed in the examination. Never ignore, your ignorance will be cost for attempting the solutions in your main examination. Thank you. All the best for your examinations. Bye, Ma.